Hello, and welcome to Masterclass Future Series Spreads and Options. This is Lesson 1, Trading Futures Spreads with Futures Plus. My name is Brandon Wendell. I'm a trader and trading mentor, and I'll be your guide for this lesson and the subsequent lessons here in the Masterclass regarding the Future Series. Before we get started, just need to go through a couple of quick disclosures here, and you can go ahead and read through those. They are available in the disclosure margins, disclosures, and disclosures for Tradestation. I am actually a contractor. I do not work directly for Tradestation. I've been asked to go ahead and speak regarding this education information. There is always risk of loss in the markets, and especially when it comes to futures, be sure that you fully understand them before trying to trade them and practice in simulated mode before trying to put any real monies at risk as well. So my background, in case you're not familiar with who I am, my name is Brandon Wendell, Charter Market Technician. I'm a trader and trading mentor. The Charter Market Technician designation, or CMT, is kind of like a master's degree in technical analysis, where I attained it back in 2008, and I've been using it ever since to help me identify the right ways of identifying opportunities in the markets. I started off in the industry as a retail broker, then moved into back office operations for a brokerage. So I dealt with order flow there and dealing with the customer orders as well as institutional and brokerage orders. I became a private hedge fund trader for a while, trained other traders for the hedge fund, and eventually became a full-time trader as well as instructor of trading in futures, options, and Forex. Primarily, I trade futures now with a bit of options as well, and the combination of options on futures, which we'll talk about in future lessons. So I've been doing this for quite a while, and we'll go ahead and jump right into our agenda, which is basically starting off figuring out what the heck a futures spread is and what they mean to us, why we would trade them. First of all, I want you to get the notion of options out of your head for right now, because this type of spread has nothing to do with options. It is simply trading futures versus futures. We'll talk about how future spreads quotes work and how to chart the future spreads. We'll talk about the margins and how to trade them as well, and using them as either a substitute for directional futures trading, or we can do what's called seasonality and take advantage of high probability opportunities that happen on a regular basis along with the calendar. And we'll also do a demonstration of future spread trading with Tradestation Futures Plus, which is the platform you would use to trade spreads on futures. If you're doing that through your account at Tradestation, you would need a Futures Plus futures account with Tradestation. There's information on that as well available on the Tradestation website. So first, what is a future spread? Well, a future spread is the same thing as it would be with an option spread. The spread is simply buying one contract while simultaneously selling a related contract. So you're buying one and selling one at the same time. And it can be done as a single transaction where you do both together, or it can be separate transactions depending on the broker that you use to be able to effect this. And you're basically doing this to take advantage of the relationship between the two securities. So instead of trading a futures contract against the US dollar, because you buy a contract hoping it goes up in value, or you sell a contract and it goes down in value, you're basically trading one contract against another, trying to trade the variation between those two related contracts. So we'll talk about how that works. As an example, here we have a line chart of corn, and this happens to be December 2024. And that's just one security. That is corn priced in US dollars. Looking at that quote, we're right around $4.10. I know it shows as 410, but it's actually $4.10 per bushel. Well, if we take a look at March corn, that's the same underlying security, corn, but it has a different expiration. It's a different contract, and it trades at a different price. It also will move at a different pace. So basically, the spread is nothing more than that white space between those two securities. That's all it really is. And you can see they sometimes get wider and sometimes narrow. And we can actually trade that and potentially profit from it. So that is what a future spread is. It's the price difference between two related contracts. You see the green right there, getting wider, getting narrower, getting wider. So spreads can widen or spreads can narrow. And you could buy the spread for it to widen and grow in value, or you can sell the spread anticipating it shrinks in value or drops in value. The contracts could be for the same underlying security, but for different months, like I showed you with corn, December versus March, or July versus August, whatever it may be, whatever 2 months you choose. Or we could use, in this case, July crude oil versus December crude oil. Well, you can also trade on related underlying securities. They don't have to be the same security. It could be gold versus silver. Those are both precious metals. They're very, very related in the way they trade, in the prices that they trade. So just, and imagine that, the first security is trading at $51.35. The second is traded at $53.17. The spread is just simply the price difference between those two. In this case, $1.18 difference between $54.35, $53.17. That's the spread. Well, if you bought that spread, what would happen potentially is if the first security moves up to $55.16, the second security might have also moved up, but not as much. Well, the difference between those two, $55.16 and $53.85, is now $1.31. The spread widened from 118 to 131. That's what you're trading. And the profit would be the difference between $1.31, $1.18. So that's a widening of the spread. The widening of the spread is when two related securities move away from each other. The price expands between the two. So again, if you have price number one at 21.46, price number two, 21.22. The difference between the two is 24. Well, if price one moves up to 21.61, price number two also moves up, but not as fast, up to 21.30. That spread has now widened to 31. So that's a widening of the spread. Notice both underlying securities moved in the same direction. They didn't move at the same pace. That's what a spread does. It takes advantage of that difference in movement between those two securities. A narrowing of the spread would be if one contract moved faster than the other and the difference got narrower. So again, let's imagine that price number one is 143, price number two is 118. That spread right now is 25 points between the two in price. But if price number one moved up to 148, however, price number two moved up to 129, that spread is now only 19. So what happened was the second security moved up faster than the first, and the spread actually narrowed. So two related securities can move in the same direction at different paces, or they can even move at different directions. And the spread can work on either one of those, depending on which type of spread you place. So widening would be the two underlying securities move further away in value, and the spread widens, the difference in price widens, or the two securities get closer together in value, and the spread narrows. So basically, a spread, we have intra-market spreads, and basically an intra-market means intra, buying a futures contract and selling a futures contract on the same underlying security. They will have different expiration months, though. That's the difference. Obviously, you can't buy and sell the same contract, because you would get in, you get out. So in this case, you could do crude oil December 2024 versus January 2025. CLZ 24, CLF 25. You could do NASDAQ December 24 versus NASDAQ March of 2025. Or you could do bonds. And you could do the 30-year bond December 24 versus the 30-year bond March 2025. Those are two types of, there are two types. Sorry, I was saying there are three different examples, but there are two types of intra-market spreads. You have what is called a bull spread, and you have what is called a bear spread. And both of those are for intra-market spreads. Again, the intra means same security, different months of expiration. So what is a bull spread? A bull spread is buying the front month, meaning the one that's going to be having the most volume, and it's usually expiring the first, but it doesn't always mean that. Okay, there are contracts that are front months that are not expiring the most recent, next. Let's put it that way. The front month is always the one that has the most volume being traded. Okay, the bar months or back months are all the other months that are out there. So if you're buying the front month, the reason why you would do this is that front month has most volume. It usually moves furthest and fastest in whatever trend direction that security is traveling. So if you're in a upward direction, the front month will move up faster than back months will that have lighter volume. So you buy the front month and sell the back months. So you do a bull spread. And you do this because you're reducing the risk of the directional move. Remember, you're trading the difference. Both of those securities will move up, but the front month should move up faster, widening the spread. If you just bought the front month and it didn't go up right away, it started going down, you would lose money. If you are long one and short the other, if they both go down, you're basically neutral, covered, and then you profit only if they differ in price, if it widens. You would lose if they narrow in price. So it is possible to lose money in spreads, but because you're going both long and short on the same underlying security, you have less risk. You also have a lower margin requirement because of that. Well, if the markets are going to go down, you would do what's called a bear spread. So if you expected, let's say, natural gas to drop in value, you could sell the front month and buy the back month. Because the market has the front month has the most volume, it should go down faster than the back month in value. So if you're short on that front month, you'll profit on the short, you'll lose on the long, but you lose less than what you gain, and you have a net positive. So greater liquidity and greater volume usually causes the front month security to move faster in whichever direction the trend is. So with a bull spread, you're buying the front month, selling the back, anticipating it's going to go up more, and the spread widens. In the bear spread, you're expecting that front month to drop faster. You're short on that one and long on the back month, and that way you profit from that spread direction. Now, the other type of spread that we have is called intermarket. With intermarkets, you're going to buy a contract and sell a contract on a different but related security. That's a key thing. It's got to be related. You can't just do gold versus wheat. And there's got to be a relationship between the two. Wheat versus corn, or more importantly, maybe corn versus soybeans. If you're not familiar, corn and soybeans grow in very similar environments. They use very similar seasons and land and equipment. Farmers have kind of a choice of which one to plant. So those are very related securities. Or crude oil and gasoline. And one's a refined product of the other. They're related. So we have examples here of gasoline and heating oil. Okay, those are related to each other. You have the NASDAQ versus the Russell 2000. You have the euro versus the British pound. Those are your European currencies. So you're buying a contract and selling a contract on a different but related security. That's intermarket. Now, with those expirations, they don't have to be the same. They can be, but they don't have to be. You could trade 1 month versus a different month. Okay? So when it comes to intermarket spreads, the intra ones are easy because they all are the same underlying security, which means they have the same tick values and same point values. And you would just simply say, okay, whatever the price difference is, multiply it by the tick value or point value, and that's your profit or loss. When you're dealing with intermarket spreads, that's a little more complicated because they're different. The NASDAQ has a $20 point value. The S&P has a $50 point value. If you trade British pound, that's $62,500. The euro is 125,000 euros. I should have said 62,500 pounds, not dollars. So we need to adjust for the values and for volatility as well. So what happens is we're going to use something different than what you see on a chart typically. When you look at a chart of a security, you're looking at what's called the market value of that security. Okay, so the value of that security is whatever the market gives it. You also have what's called notional value. That's the actual value of the futures contract. And notional value under one contract, let's say you trade one corn contract. One contract of corn is 5,000 bushels. So you need to know what 5,000 bushels worth. Remember, when we were looking at that one quote, it was $4.10 per bushel. Well, one contract is 5,000 of those. So you have to multiply whatever the market value is by the point value, and that gives you notional value. That allows you to compare related but not the same securities. And it'll also make your charting a bit easier as well. So typically for intermarket spreads, we will use notional value on our charts. So the way we do that and chart it is you just simply take the securities. Let's say we're going to do the E-mini NASDAQ, the NQ, versus the E-mini S&P, the ES. And we can trade those against each other. They're related securities. They're both equity indexes. But the point value is different. The NASDAQ point value, let's say it was at 21,211 points right now. That one NASDAQ contract has a value of $424,220. The ES has a $50 per point value, okay? And actually, I need to make a little correction here. I've got the Dow versus the E-mini S&P, so bear with me for one moment. Let me fix that. Okay, so quoting the intermarket spreads, we want to use the notional values rather than the market values that you see on a chart. So let's say we're comparing the E-mini NASDAQ 100 versus the E-mini Dow 30 futures. Well, if you take a look at the NASDAQ 100, that has a $20 per point value. And let's say the market shows right now 21,211 on the index. That one NASDAQ 100 futures contract is worth $424,220. However, the Dow is only $5 per point. Well, if the Dow was trading at 44,882, that means one Dow contract has a notional value of $224,410, or basically at 44 times 5. Well, if you chart it NQ December 2024 versus YM December 2024, but you're going to be doing it as a notional value, one minus the other. And as a matter of fact, I think that's what it shows on my chart. NQ minus YM, it should show the physical difference between those two, 424,220 minus 224,410, and that's showing around 199,805 at that point. It may not be exact because prices were moving just slightly as we were charting this. So if I bring in a calculator just to show you, 424,220, which is the notional value of the NASDAQ, minus 224,410, notional value of the Dow, you can see it's pretty close. It was 199,810. Again, we moved by a little bit before I took the picture. But we chart the notional values on intermarket spreads. So again, we can actually see this using a platform. Tradestation Futures Plus has what's called Auto Spreader, and you can create that chart using the Auto Spreader. What you would do is bring up the Auto Spreader widget and then create a spread. Hitting the create button, it would bring up this edit spread. You, under leg 1, would choose NASDAQ December 24, and then on the second contract, YM December 24, whatever ratio you wish to trade them in, long on one, short on the other, and the multiplier is the point value. So let's look at an example. If I go out to my Tradestation Futures Plus, I can go to my widgets, move down to automation and auto spreader and open that widget. Here we have it. So if I want to create a spread, I simply go to create, as I mentioned. Here I can name the spread. So let's say we want to do corn versus soybeans. So I'll just type in ZC minus ZS. That's what I'll name it. Or I can give it the full name, corn versus soy. Now, for the spread formula, I select the contract, and I can explore all the contracts, or I can try to search, and I'll just type in ZC, and it brings up corn, since I know that's what I want. Again, ZC, I hit enter, or actually I can click on the individual contract. So I'll click on the March 2025 contract for now. In the second, again, I go to select a contract, search for the instrument. I know I want soy, ZS, and let's also do the March 2025 contract. In this case, we have ratio of 1:1, so I'm going long on corn, short on soybeans. The point values are the same, so I could leave this at 1 and -1. However, if I want a notional value chart, well, let me just show you the difference. First, I can go ahead and save. And it should show up on my list once it is saved. Based on the last modified. There we go. Locally, corn versus soy. There we are. So if I click on that and click on open, I can open a chart or I can open trading for it as well. So this one I did with just the market values. As you can see, it is simply the price of corn minus the price of soy. However, if I wanted to create, again, corn versus soy notional, the difference is, again, I'll go in, type in ZC, choose the same March contract, go to this, ZS, choose the same March contract. However, $50 per point for the multiplier, negative 50 for the soybean multiplier. Hit save. And there it is at the top of my list again, because I'm already done, or I've already gone and done the last modified sorting for the most recent. I could choose to share this with the public, or I could keep it private for myself. You saw under the create, you can actually push the little share button and I'll share it with everyone else if you choose to. So clicking on this notional one again, if I bring up open chart, it should open the chart for me. Here it is on a separate tab. And you'll notice the prices are different. The reason why the prices are different is this is the notional value. The advantage of a notional value is whatever the plus or minus is here, that's the actual profit or loss. So let's increase the font size so we can compare these two. There we are. So let's say, as an example, I'll put them right on top of each other. The charts are the exact same. The difference is the value. So let's say we have a move from 516 and a quarter to 516.75. Remember, this is on the negative side. You can have negative numbers on these spread charts. You're simply charting the price of one minus the other. If you subtracted something at a higher value, it's going to be a negative number, obviously. So now if I go back and bring in a calculator here, if we have 516.75 minus 516.25, that is half a point of movement. Just between these two right here. And that half a point of movement, in order to figure out how much profit or loss that would be, we'd have to multiply that by the point value. That's $25. However, right here, you see it's 25,800, 25,825. The difference between those two is 25. That's the actual dollar difference. So we don't have to do any kind of math to figure out profit versus loss. You simply figure out what's the difference between where you're getting in and where you're getting out, either profit or loss, when you use notional value. And I prefer that myself. Some people prefer to do the combination. It's whatever it is. But if you're doing related but not the same tick value, again, let me go back over and show you an example. Close these charts out. And let's create NASDAQ versus S&P. So again, I'll go NQ and I'll select NQ March 2025 versus ES March 2025. Here we have long on the NASDAQ, short on the ES. You can change those if you want to. Point value for the NASDAQ is 20. Point value for the ES will be minus 50 because you're doing it on the short side there. Again, I can click apply or save. Should save. So I've done something wrong here. And before I save this, I actually have to give the spread a name, so I can do NQ-ES. And now I should be able to save that into my list. There it is at the top of the list. Again, I can click on it and open chart. And because I put in notional values, again, as I zoom in, font size, I can enlarge that. It's loading all the information, so it might take a little bit. I happen to be on a 1 minute time frame. I can change my time frames for the charts and all the good stuff as well. Right here, intervals, let's say we do daily. And it'll take a little time to load, but you can see this will be the notional value price So if you were to subtract, let's say 131, 710, 131, 700, that would be a $10 move, period. So that's kind of the advantage of using, you see it's finally populating the different days. But that's the advantage of using notional value when you're doing those types of charts on intermarket spreads. And you create those charts using Auto Spreader, which is simply a widget found on Futures Plus. Now, another thing we might have to do is called delta neutrality. And not all futures move at the same rate. Some of them are more volatile than others, and we need to take that into account when we're charting and trading the spreads. So you might have to make some adjustments, not just with the notional values, but for volatility, meaning you might need to trade more of one contract than you do of the other. That's called delta neutrality. And the reason why you want that delta neutrality is you don't want to have any kind of a bias that if both move up or both move down the same, you lose or gain money. You should be neutral. The profit or loss comes from the movement between the two, not the fact they're both moving up or down. So when they both move up or down at the same pace, you are neutral. You're not making money or losing money. You only profit from the spread changing with those two securities. So it mitigates the directional effect. Basically, if you were to do an intra-market spread, you're delta neutral because you're buying and selling the same security different months. So you're making money when it goes up and losing when it goes up on the short, or vice versa, right? You're making money on your short, losing money on your long because you did the same security. We might need to weigh that out when you're dealing with related securities. On the CME Group's website, they have a margins web page, and it'll tell you the actual ratio you need to use. That's where you find it. So you can go to the CME Group and you can bring up any security. I happen to have brought up crude oil. And what you'll see on crude oil when you go to their page is right there, it says margins. So you can click on margins for any security, and then you can get to whatever ones you need there. Because what it'll do is it'll bring up the margins for that particular security. Outrights are the normal margins you would expect for directional trading. Intra, well, that's self-explanatory. It's intra-market spreads, and you can choose which months. Intermarket is the intermarket spreads, and then you can choose the exchange, which asset class you wish, and specifically which future you're trading. So for instance, under crude oil, if I went NYMEX crude oil, asset class, I can use the drop-down securities and check the dates in the ratio. So for instance, here, crude oil, Brent versus light sweet crude. We have a 1-to-1 ratio. Okay, on this one, another Brent versus crude, depending on the month of expiration, August 25. This one's November 24, April 25. They have different months that you can trade. This happens to be gasoline versus crude oil. Again, simply 1-to-1 delta ratio. No big deal on that one. However, with some of these, you're going to see the ratio is different. Here we have the Russell 2000 versus NASDAQ 100. So number one, we're going to use notional values. So we'll do $50 per point for the Russell 2000, $20 per point for the NASDAQ. However, for every one NASDAQ, we have to trade 3 Russell. A side, B side. What does that mean? Well, that means if you go long on one, you go short on the other. That's all. So that's how we figure that out. And we'll talk a little bit more about margins later, but when you're looking at intra-market spreads, and some they'll tell you the maintenance margin here. Now, maintenance margin is not the initial margin you need to enter in the position. Initial margin will be 110% of whatever you see for maintenance margin. I don't know why, but they show the maintenance margin on the CME website under margins. You just simply multiply whatever number you see there by 1.1. So let's say we wanted to trade gasoline versus crude oil on the April 2025 spread. Again, if I bring up my calculator here, we have a maintenance margin, 2,082. You simply multiply by 1.1, and 2290.2 is the initial margin to open that particular position. Now, on intermarket spreads, sometimes you'll see it as a credit given. So whatever the spread, whatever the initial margin would normally be for 3 Russell contracts and 1 NASDAQ contract, you only have to come up with 30% of that. So it'll be less than the full margin, but there's still a cost of margin, a deposit you have to put down in order to be able to trade this. Additionally, some of these may not be one. If we look at others, such as British pound versus euro, that is a ratio of 5 to 3. So if you're buying British pounds, that's the A side, you buy 5 contracts, you would sell 3 euros. If you were selling the pound, you would buy the euro. 5 to 3 would be the ratio, no matter what it is you're trading. The margin credit, again, you're trading 8 contracts. You would add up, find out what the margin is for 3 euros and 5 pounds. Take 65% of that off. You only have to come up with the other 35%. So, whatever 35% margin rate is for those securities at the time, and they change. Again, you look at the website, the CME website for that span margin. But that's what you would have to come up with. You can have multiple leg spreads. Here we have an agricultural spread with feeder cattle, live cattle, and corn futures. 4-2-1. Notice 2 are A side, 1's B. So if we were buying live cattle, we would sell feeder cattle and corn, and we would get credit for 66% on the margin for all of those 7 contracts that you'd be trading. Those are a little bit more advanced intermarket spreads. We won't get into that right now. So basically, when we're charting spreads, we chart it a little differently. You're not going to do it with one on top of the other. Right here we have December corn, March 25 corn. You don't want to put those two together on top of each other. It gets a little confusing. Instead, we simply chart the spread or the price difference between the two. The December corn was trading at $4.18 or $4.18. March corn was trading at $4.35. So one minus the other is 17 cents. That's all. So we're simply charting the physical difference between those 2 contracts. That's how we chart spreads. And you saw that when I charted the spreads in Tradestation Futures Plus. This happens to be the NQ versus ES. And again, if I zoom in here, you can see this is the price difference, notional value of one NASDAQ contract, which is around $400,000, minus the price of the ES, which is somewhere around $300,000 right now. So that's the price difference between those two. So charting intra-market spreads, that one's, again, a little bit easier because it's the same security, just related, it's different months. Exact same security though. Either one can be put first. It doesn't matter. But typically, a lot of people will put whichever one they're buying goes first. So if it's the front month, then that's a bull spread. You're buying the front month, selling the back month. If it's a bear spread, well, then you're buying the back month. You can put that one first on the chart. You just got to make sure you hit the right button to buy or sell so you're doing the right action that you wish. So if you are charting, whichever one you chart, if the chart moves up, that means that first security you put is actually going up in value versus the second one. It's getting stronger. If the chart is moving downwards, again, it's the front security getting weak against the back. Okay. And if you're using just the market values when you do intra-market, which most people do, then you simply multiply by the point value to get the profit or loss. So in this case, if I could zoom in here and show this, we have, it's kind of hard to see, but I have 0.57, 0.63. The amount of risk there is 0.06. That's the difference between those two. And times 1,000, that's $60. Because what I'm charting is crude oil January 2025 versus February 2025. So this is a crude oil spread. So if I'm selling this, it would be a bear spread because I'd be selling January, buying February, expecting the value to go down. Well, if I target this area, 0.24, the entry was about 0.57, that difference is 0.33 times 1,000, that's $330. That's it. Pretty simple when you're trading the intra-market spreads. You simply figure out the difference, multiply it by the point value. Now, intermarket, I mentioned we're actually charting notional values. So in this case, I'm doing gold versus silver. Silver is $5,000 a point, gold is $100 a point. And we do one versus the other, we get credit for 70% of the margin in this case, whatever that may be, and we chart the notional values. In this case, I have gold versus silver, so gold is actually shown first, and the price of gold minus the price of silver is what we're being seen here. based on notional values, of course. So again, I put in gold February 25. This is on the auto spreader. Silver March 2025. Notice different months, February, March. That's fine. You trade whatever the most active contract is, or whichever one you want for that particular seasonal move, which we'll talk about. The multiplier, gold is 100, silver is 5,000. You can see on some of these spreads, again, not just notional values what I need. This one was a 1-to-1 ratio, so we need notional values only. Sometimes the ratio might be different because, again, the ratio has to be different here for the delta neutrality. So if we're doing the Russell versus NASDAQ, it's a 3-to-1 ratio. The notional value for the Russell will need $50 a point. NASDAQ will be $20 a point. So bringing up the auto spreader, you'll notice I use 3 Russell versus 1 NASDAQ on the sell side. Point value, point value. So charting that, again, it will be the notional values being charted and 3 Russells, only 1 NASDAQ. I build that on the open spread. Build that on the auto spreader. Then once I have it listed, open chart. And there it is. There's the notional values with the correct weighting. 3 Russells versus 1 NASDAQ. So again, charting these, if we're using notional values, it makes it a lot easier figuring out profits, risk, all that stuff. So we're calculating this. The risk is just difference between wherever you're getting in and wherever your stop price happens to be. So in this case, if I'm shorting or selling this contract, I'm selling the selling the Russell, that's the first one, buying the NASDAQ on a 4-hour chart, I'd be selling at 297,690, buying to cover if I'm wrong at 296,430. That's a difference of 1,260 points or $1,260 because I did this notional value. If I'm selling at 297,690, buying it at 303,010, that difference is 5,320 points or $5,320. Again, notional value is what I'm charting. Much easier that way. So if you want to know the spread margins, as I mentioned before, you simply need to go to the CME website at cmegroup.com, and you can go to any security and go to the margins for that security. You just click on the margins tab that pops up for that security. If you want to look at the outright, for those again are just buying or selling that underlying security, that's fine. In intra is the intra-market spreads, and you just have to make sure you look for the right date. Or you can do the inter-market spreads. And let's see if I go back and click on this link, if it'll let me. There we go. So here's the CME website. Under markets, I'll click on crude oil. Doesn't matter, I can pick on any of those. And again, I go to margins. Here it is. Outrights, if I want to trade the January contract, there's the maintenance margin. Again, multiply that by 1.1, that's my initial margin to enter the position. If I wish to do an intra-market spread, I simply click on intra. Now I have to find the dates that I wish to trade. And notice some of these are a little bit different. The ratio, you notice we have 1, 2, 3 different contracts here. If I just want a simple spread, I have to find 1-to-1 on the intra-market. I might have to search a little bit in different pages to find it. Unfortunate, but those are some of the more popular spreads, are a little more advanced. If you're familiar with the way that some of these spreads work, they're very similar to the spreads you would have for options. In this case, you can see 1 minus 2, 1, that's a butterfly spread. But again, that's a little more advanced than we're going to get to right now. So what I'm going to do is keep scrolling through, maybe skip a page or two until I can get to the 1-to-1 ratios. It's taking me a little while to get to those for some reason. And let me see if I can actually, nope, I'm in the right spot. I just have to keep going until I find them, unfortunately. It used to be right in front, but now they have these other spreads that are there, unfortunately. So I just keep going back, and eventually I'll find the 1-to-1 or 4. Anyway, while we're going through this right now, I'll go to the intermarket spreads. And let's say I want to trade crude oil versus heating oil. Well, I'm on crude oil. I just look to find heating oil. Again, it's not on this first page. I could also always do a search. Gasoline is there. And again, they show you the intermarket spreads. It happens to be 1-to-1 ratio. But I can keep going page to page until I find the one I'm actually looking for, which again would be HO. I could also just Control F, search for HO, see if it's on that page anywhere. Nope. Again, go to the next page and search until I find the one I'm looking for. Or, since I know I'm looking for heating oil, I can do the other way and go to refined products, heating oil, and then look for that versus crude oil and do it the other way. Anyway, that's what you would have to go through the CME website to find some of those margins. And this is, again, just kind of showing the steps. Go to intra, you can search for whichever security you'd like, and you find the ratio as well as the credit that you get. Find the pair, the ratio is the number of contracts on each side, credit is how much margin is credited to you. You must come up with the remainder for the initial margins. Now, when you go for the spread margins, again, we use the initial overnight margin rates. And in this case, well, if we wanted to trade 3 live cattle, you can see that the long overnight margin rate for live cattle happens to be $2,695 per contract. Times 3, that's $8,085. And the ratio I need is 3-to-2. I think it showed that on the previous page, right? Yeah, there it is. Feeder cattle 2, live cattle 3. 65% credit. So you'd find the initial margin, live cattle $26.95, feeder cattle $45.38, and you multiply them by the ratios. So total, that's $17,161 of margin required. But we get credit for 65%. So 35% that's left is only $6,006.35 for the overnight margin. Margins are much smaller on spreads than they are on directional trades because the risk is reduced as well. But so is the reward. It's always reduced. So some of the advantages of doing these types of spreads, well, one is they work in any market condition. It doesn't matter if the markets are bullish or bearish, you're trading the difference between the two or the relationship between those two markets. So you can profit in bullish markets, bearish markets, sideways markets. Kind of nice. Another pro is risk reduction. You're both long and short. You're delta neutral. So you basically have almost no directional risk when done properly. And you have very low drawdown typically on spreads. You can have losses. Don't get me wrong. You can have drawdowns if you do this incorrectly, but it is reducing the drawdowns you might have versus directional trading. A stock or a futures contract moves against you and you went directionally with it, you're going to lose right away. With a spread, remember, you're both long and short. You're trading the price relationship between the two, which is going to move differently than the actual movement of an underlying security. And the lower margin requirements are very, very nice. Again, going back to an example here, if I go to the CME website and I go to an outright spread on, let's go here. We'll go to CME, equity index, and nice expensive contract is the NASDAQ. You want to hold the NASDAQ overnight right now. It is a maintenance margin of $22,448. That's just one NASDAQ contract, 22,448 times 1.1. Initial margin is $24,692 for one NASDAQ contract overnight. But what about a spread? We click on intra. Again, I can go to, funny, they changed the website. It used to show the 1-to-1 ratio first, and now it's not. But instead of spending, I think it was what, $24,000, you're going to be spending more like $2,400, usually close to 1/10 the amount. Oh, wait a minute, I'm on the wrong page again. I went to intra, but once again, I got to go back to CME. That's what happened there. Equity index, NASDAQ. I didn't realize that before I kept clicking. And there it is, 1-to-1 ratio. So if I want to do, I'll zoom in so we can see this a little better. If I want to trade the NASDAQ versus NASDAQ using March versus December, well, the margin is going to be much less. That's the full-size NASDAQ, $297. So I was way off. Instead of $24,000, again, it's $297 times 1.1, $326 to hold overnight. Yes, that's for a full-size NASDAQ contract. You won't make nearly as much, but you don't have nearly as much risk. If you want to go further out in time, you just find the correct dates you're looking for. So any time between 12/24 and June. Say we want to do the March versus June spread. Now that's $695. Oh, actually, yeah, we have to multiply that by 1.1. So to trade the March 2025 NASDAQ long and short the June 2025 NASDAQ, that's $764 a margin versus $24,000 for just one NASDAQ contract overnight. So the margins are greatly reduced. You can even do the micros as well. If I show them here on the website, let's see, MNQ, there we are. And look at this, MNQ, December 24 versus March 25, $33. I don't have to multiply that by 1.1, it's in my head, it's fine, $33. Or $77 if we wanted to do the March versus June micro contract overnight. $77 for the margin. Pretty neat. So low margin requirements, but again, lower risk as well, lower reward. Well, some of the cons are correlation failures. Okay, just because things worked in the past doesn't mean they're always going to work. So you got to make sure you put in protective stops as well. We'll talk more about that in more advanced strategies in the next lesson. You also have to pay for multiple contracts. Instead of just buying one or selling one, you're buying one and selling one. So you have two commissions and multiple fees. And liquidity, you have to be careful of with your trade fills. Okay, if you're not trading the front month contract, the lower volume may make it a little more difficult to get in, or if you do get in, you might have a bigger spread to deal with. Spread being the difference between the bid and the ask. So you might have to pay a little more to be able to put on a spread trade than you would if you just did a directional trade. But again, the advantages on the other side of the lower margin requirements and the stability in the markets may be worthwhile doing that. And leverage. You have to understand how leverage works if you're going to use it and be comfortable with it. Over leveraging yourself could be very, very dangerous and leads to a lot of drawdowns and big losses in the markets. So be careful. So we have a couple of different ways of trading these. And the first way is directional trading. That's probably the most common way of trading future spreads. Directional trading. Okay, and directional trading, you basically intramarket use a bull spread for the upward move or use a bear spread for the downward move. And well, the nice thing is, again, I showed you with the NASDAQ, I said spending $24,000, you spend a couple $100 in order to be able to do a bull or bear spread, you obviously will not make as much money. Percentage-wise, though, you probably will get a good rate of return, maybe even better. Dollar-wise, you won't make as much because you're not spending as much, you're not risking as much. Again, risk and reward go together. But the nice thing is, again, with the directional trading, lower profits than directional trading, but lower margins and possibly better rates of return. You can also do what's called abnormal relationship identification. Actually, I'm not sure what the name would be for this, but you have what is called contango and backwardation. Contango is the normal status for the markets. For instance, if I go to a quote, here I am on crude oil. And on crude oil right now, we are not in contango, are we? We're in backwardation, which is interesting. Backwardation is when the front month contracts are more expensive than the back month. If you think about it, the longer you hold on to a contract, say May of this year, for instance, May of 2025, you would have more risk holding a longer term contract than you would on a short term contract. Those longer term contracts should be more expensive. The front month one should be the cheapest. Let me see if I go to a different security. Close this out, go to markets, and perhaps NASDAQ. See how that looks under a quote. I'll come back to crude in a moment. Quotes again. And here we are. This is contango. Contango means that the front month is the cheapest. So again, I'll zoom in and you can see December, 21,181. March, 21,400. June, 21,700. The further out in time you go, the more risk you are taking because there's more time for things to move in one direction or the other. So they're more expensive. That's a normal market, normal, healthy market. Contango. Backwardation is what we just saw. I go back to the CME and to crude oil quote. This is backwardation. Oops. Where the front month is the most expensive. That's typical of an abnormal market and somewhat bearish at times, not always, but it can usually be a bearish market, meaning prices as a whole are dropping. Contango is the normal status for a market. So even though these are backwardation right now, they will typically take over time, they'll go back to contango. So how would that happen? Well, if all the contracts are dropping, maybe these back contracts don't drop as fast as the front does at some point. Right now, they still are. They're actually dropping more. Okay, perhaps we're moving up. Well, maybe the front month doesn't move up as fast as the back months then. And eventually we get back to contango. But it could take months, sometimes even years. But that's one way of trading is if you're in backwardation, you could trade for contango to return. Normal relationships and correlations, they break down, but they usually come back to the norm. Gold and silver are related within a certain ratio, and sometimes they get out of whack, but they do come back. News can throw off prices, and you can trade for them to come back. Well, again, we'll talk more about this in the next lesson as well. You could also trade things like the crack spread or the crush spread. It's a commodity spread. A crack spread, for instance, is crude oil, the raw product, versus a refined product like heating oil or gasoline. Or a crush is soybeans, the actual beans, versus soy meal or soy oil, the finished product. So you can trade some of those, and that's a very common way of trading spreads. Again, something we'll talk about in future lessons here. So when it comes to directional trading, again, you do this when you're expecting a large move up or down. The front month usually has higher volume and moves the fastest. And you could buy it if it's going to go up, and you sell the back month to protect yourself and lower your margin. And you still profit if the front month moves faster than the back and the spread widens. If you're shorting, same thing. You think that the markets are going to go down, sell the front month, buy the back month. You're protected in case they both move the same against each other, but the front month should move faster. The margin is going to be much lower than trading a single contract. Rewards lower, but there's price protection against adverse movements. So in this case, we have crude oil, and I took this picture a bit ago, obviously. And that's just showing the price difference between the two. Again, you can see that even intraday, they don't move at the same pace. All these moved up, but the front month, the one with the most volume that day was November at the time. It moved up 97 cents, while the December contract only moved up by 92 cents. There was a 5-cent difference or $50 profit to be made at that time if you had caught it. And it can become more and more over time. Spreads are usually traded not necessarily intraday, but over multiple days, sometimes even months. So in this case, you could do an intra-market spread on soybeans. If you're expecting soybeans to go up in price, you could buy the front month contract with the margin needed. In this case, it was $2,200 at the time, or you could trade a bull spread. And the spread was only $660 margin. Okay, well, again, less risk, less profit. But the moves are going to be, again, percentage-wise, pretty good. You can possibly even make a better rate of return using less capital. Now, intermarket spreads, there's a couple different ways of trading this. Because again, you're trying to chart the actual spread, which is the price difference between the two related securities. You do it on notional value. You could do it based on charts. Pretty much the same way you chart other securities in technical analysis and trade them. With chart-based trading, you can enter when prices reaches a buy zone or sell zone. Supply or demand, support, resistance, whatever it is you trade. You can sometimes use it when it's going into Bollinger Bands or moving away from midpoints. Bollinger Bands are a nice tool that you can use. Basically, it shows you standard deviation. So if prices are outside by 2 standard deviations, that's unlikely to stay there, and you're likely to bounce back and go to the mean or the average. Or if you're at an average, you're likely to go away from the average at some point. So you can trade for the spreads to widen or narrow based on Bollinger Band trading. or just simply supply and demand, again, support and resistance. So we're going to explore that in lesson 2. That'll be the next lesson, future spread trading techniques and tactics, where we'll get a little bit more in detail on how you can actually do that. I want to thank you for your time, and hopefully you learned what future spreads are and how they are traded. We'll do a little bit of review, and then again in the new lesson go into how to actually trade those in more detail. Once again, there's always risk involved in these markets, especially when it comes to using leverage as well. So make sure you understand how margin and leverage works, and you can see all the disclosures and disclaimers on Tradestation's website using the links provided there that you see in front of you. I want to thank you for being here. Once again, my name is Brandon Wendell, and this was Lesson 1, Trading Future Spreads with Futures Plus.